Good morning, everyone. Welcome to today's Phillips Securities Research Morning Call. Last Saturday, we had our Singapore strategy and stock pick. So today, we will be doing the strategy and stock pick summary for fourth quarter. And we'll also be having the technical pulse for S&P 500 and also several counters such as VOO, GLDM, and Bitcoin ETF. And we'll also be having ETF monthly for September. This is the disclaimer slide. Any information provided is solely for educational purposes and not financial advice. Without further ado, I'll hand over the time now to Zain. Thanks.
Thanks, Sigmund. Good morning, everyone. First one, I'll talk about the technical. So first one on the S&P 500. Last week, we saw a new all-time highs on Friday. So on a weekly basis, we were up 1%. And I think we are likely to see this trend of high highs continuing this week, especially with the price actually currently remaining above the blue line in the chart, which is the 5-day moving average. So that's very strong momentum. As for current resistance, likely to be at 6,755 to 6,880 area, which is the current around the upper Bollinger Band on the daily, as well as the short-term trendline resistance you see in the chart. As for current support, likely to be at 6,645 to 6,700 area, which is that will represent a retest of the strong upward support line in blue in the chart, as well as the breakout level of last week. Next slide, please. So next one, this table just summarizes the technical calls initiated last week. So first one is NVIDIA, which is currently in progress, is up 0.5%. The next one is AEM, which is currently in progress, up 12% as of last Friday. Next slide. So first one, this one is our ETF monthly for September. So we titled it Most Asset Classes to Extend Their Gains in October this month. So first up, to review how the various asset classes did. Almost all of them were in the green except oil, which was basically flat. Top gainer was ETF tracking gold GLDM, which surged 11.7%. Some of the other notable gainers include ETF tracking Bitcoin BITU, which was up 5.3%, and 2828, which tracks the Hang Seng Index, that was up 7.2%. As for the current trends, most of them are in an uptrend, with the exception of oil and Bitcoin, which are in a range consolidation. As for outlook for October, we expect most of them to continue the gains this month, which are S&P 500, US Treasury bonds, Bitcoin, Singapore equities, and Hang Seng Index. For gold, we expect the price to perhaps pull back slightly following the recent strong rally. And then for oil, we expect the price to actually continue sideways consolidation. Next slide. So first one on the S&P 500 ETF VOO, you can see that the uptrend is still very steady. In September, prior to the start of September, price actually consolidated sideways at the $595 level. And then when September came, there was a breakout of this resistance. So continue to trade in this uptrend channel in the chart. And then, still just steadily trending higher. So we expect further upside to actually continue to go higher within this channel this month. Next slide. Next one for the Treasury Bond ETF IEF price, the breakout of the $95.20 level is still holding. So the breakout of this range is still intact, and price actually at the start of the month there was a breakout of the resistance, and subsequently from mid-September there was some slight pullback. We expect price to actually rebound in this month to actually retest the swing high from last month. That's about $97.20 again at this. Next slide. Next one for the Gold Mini Shares Trust GLDM top performer. So there was in September, because it broke out of this bullish flag where price was consolidating in since mid-April. So with that, that was represented a continuation of the uptrend. But however, the rally has actually there was a very strong rally already. So we see possibly some resistance at $78 to $80, and price could just do some slight pullback to retest about $75 again, and maybe just consolidate a bit sideways after. Similar to what we see back in about April this year, when after the strong rally about 2 months, then we see some consolidation again. Next slide. Next one for the oil and gas exploration production ETF XOP. So for this one, it held a breakout, held a retest of the downward resistance line breakout in September. So that's about $120. And then price actually retested about 140, some resistance, and pulled back again at the end of the month. So basically it was just flat. And we see this sideways consolidation actually continue because it's largely trading within a range between 128 to 138 in the chart. Next slide. And next one, the Bitcoin strategy ETF BITO. So for this, in September, it did a double retest of the $18.50 previous resistance, now holding at support level. So that's still positive. And overall, the formation now is a bullish flat consolidation between 18.50 to about $20.40. So we see the overall bullish trend is still intact, and I think we see price to actually continue to have a gain this month as the previous resistance still holding as support. And should we break out the $20.40 level, then we could possibly see a continuation of the uptrend. Next slide. Next one for the Singapore Equities ETF, ES3, which tracks the blue chips. So this one, we still see very steady uptrend, continue to hold in this uptrend channel in September. So we expect further upside this month to possibly test about 452 to 460 to actually retest the channel resistance again in October. Next slide. Next one for the Hang Seng ETF, also very strong. So September, we saw a breakout of a sideways consolidation about $94 to $95. And then with that, we possibly see some further upside towards $100 to $103 next. That will represent a retest of the uptrend channel resistance. Yeah, so overall, still very strong momentum for the Hang Seng ETF as well. Next slide. Yeah, so next one, I'll go through a summary of our fourth quarter Singapore equity strategy event held on Saturday. So we titled it "Follow the Money" because we think that the Singapore market is currently undergoing a meaningful re-rating of valuations with the ongoing liquidity boom from the 5 billion EQDP plus, involving the additional third-party capital to be raised, and also we also have a lot of share buybacks from the major corporates like DBS, Singtel, as well as Keppel. So if you look at the picture, actually it shows our second quarter strategy, where we saw a lot of value in terms of the mid cap, small cap, as catalysts. However, and we think that it could be alive and moving. And value alone is not enough. We need the value to be unlocked, and we are currently seeing that with ongoing liquidity coming into the Singapore market. Next slide. Yeah, so in terms of technical outlook for the third quarter, it was overall very positive. You see the Singapore market not just posting gains, but very, very strong, stellar, outstanding performance in the third quarter with double-digit returns in both the benchmark as well as small caps and mid caps as well. So very broad-based returns. And basically, the overall market was just on a rocket ship upwards. And we think that in fourth quarter itself, we see this upside to actually continue on. Next slide. So first one, I'll talk about the chart of this ES3 ETF, which actually is an ETF that you can trade that tracks the blue chip benchmark. So in terms of the chart, it's steadily trending higher in this uptrend channel in blue. So there's been a very strong quarterly performance, about 6 consecutive quarters of gains. In third quarter, it was up 10.1%. Very strong bullish momentum is demonstrated by the breakout of this trendline resistance in black that happened in the start of July. And from then on, price has been steadily trending higher in this uptrend channel. So we see a continuing further upside for this ES3 ETF to possibly hit about 475 this quarter in the fourth quarter. That's about 6.2% upside from Friday's close. Next slide. So next one I'll talk about is the small cap index. So for the small cap index, third quarter was a very significant quarter. So because if you look at the chart in 2022, price has been just steadily trending downwards. And then afterwards, it entered into a sideways slumber between 2023 July to about until this year, 2025 July. So that's about 2 years of sideways at 217 to 247. And finally, in third quarter, we saw a very significant breakout, and price has continued to demonstrate very strong bullish momentum, breaking above $278 level at the end of August and continuing on to just steadily go higher. So we think that for the index, continue to head higher towards the next key resistance at 308, which was last seen back in August 2022. So that's about 4.4% upside. Continuing on for the 15.8% stellar returns in third quarter. Next slide. So next one, this is our large cap stock pick based on technicals. So it will be City Development, CDL. So for the chart, we see a fresh breakout of consolidation. So in terms of the chart, similarly to what we saw in the small cap index earlier on, price was actually just trending downwards since 2023. However, this year we see the trend actually, we saw a bullish reversal. Since July, there was a breakout of the $5.43 resistance, and then price moved higher towards about $7, where it consolidated in an ascending triangle formation with higher lows. And last Friday, it also broke out of this key resistance at $7.02. So we see a price potentially heading higher towards the next key resistance at $8, which was previous resistance back in between May and September 2022. So that will be about 11.4% upside from the latest price. Next slide. Okay, so for my last slide, I'll talk about the small cap pick based on technicals. So that will be Zixing. So for that is we're currently awaiting a breakout of a consolidation. So for Zixing, the key resistance is at 0.036. And price has been trading in the ascending triangle consolidation, forming higher lows along the way, which is a positive signal since July of last year. And with multiple retests of the resistance, we do see price possibly breaking out of this resistance finally to actually go higher towards 0.046, which was a previous swing high resistance back in mid-February 2021. So that could represent a very attractive upside of about 35.2% from Friday's close. So that's all from me from the technicals. I will hand over to Glenn, who will share more about the Singapore banks. Thanks.
Thanks, Zane. Yeah, so we'll be covering the Singapore banks. So the title here is Sheltering from Low Interest Rates. You can just see this bank executive. This guy is holding an umbrella, trying to hide away from the falling interest rates. So there's several ways that the banks are trying to do this, and the effectiveness of it as well. So next slide, please. Yeah, we'll go through DBS firstly. So DBS is our preferred pick amongst the three Singapore banks, mainly because of their dividend payout ratio and just their dividend policy. So you look at this chart here, the orange line is the DBS's dividend payout ratio. It is the highest amongst the three local banks we expect it for the next 2 years at least. The main reason for this is because they are the only bank that is giving a fixed dividend per share, and their dividend policy is not tagged to a payout ratio, unlike their peers like UOB and OCBC who are sticking to this 50% base dividend payout ratio, and then the capital returns is either 10% extra or 50 cents per share extra. So that's the reason why we prefer DBS. And also for DBS, they have given a lot more guidance to their dividends. Like for example, they did mention that they will be continuing with the ordinary step-up dividend of 24 cents per year. So they'll be doing that all the way until the end of 2026, whereas the other two are keeping quite quiet on this. And DBS is also able to keep this up, because they do have a lot of deposits inflows, a bit more than the others, and they are able to benefit from this because they do a lot more hedging than the other two. So it's a bit more that it is not really beneficial for their margins, but if you look at their net interest income, they are the only bank that actually has seen an increase in net interest income. So moving on to the next slide, we'll be looking at the other recommendations that we have for the financial sector. The other two banks, firstly OCBC. So OCBC, we expect an earnings to also decline slightly, mainly from the continued compression in margins as well as the decline in the net interest income. But for OCBC, what stands out in particular is that their dividend yield is actually the least predictable among the three local banks, right? So it's fully floating, 50% base plus 10% capital returns. So you're really not sure what you'll be getting until earnings are announced. And this is not very good because in the sense that your dividend yield might dip and your absolute dividend per share will also decline if earnings are lower than expected. And interestingly for OCBC also, is that their capital return plan, which all three banks have announced, for them, OCBC, it will actually end in this year, by end of this year. So they haven't given any indication of whether or not it will continue. And considering that they have the highest excess capital amongst the three banks, they do have a lot of capacity and room to actually give back more, right? But they haven't given any indication whether or not they will. So that's one of the, I guess, upside surprises we could see if they could continue to give the capital returns. As for UOB, we also expect the earnings to decline, mainly from the NIM compression, and also for UOB in particular, their fee income has been the most significant driver for them in the last number of quarters, especially after they completed the Citi acquisition, right? And they were able to expand into ASEAN. But what has happened recently is that their customer profile, is I guess leaning towards more of the prudent side. So they have seen a lot of their customers not actually putting their money into wealth management products or fee income products. They earn a higher margin, and what they're saying is that around 60% of it is actually they're putting it back into fixed deposits, which have a very low margin for the banks. So that's a bit of a headwind for them because the fee income growth was lower than expected. As last but not least, we have SGX. So for SGX, we believe that the heightened volatility will continue to boost their trading volumes, which is the main generator for revenue for SGX, really from the whole volatile environment and also from the Trump administration. And Singapore's standing as a flight to safety will also continue to increase the volumes. But just to highlight, that the falling interest rates will also, SGX will also take a hit from the falling interest rates, mainly because it will affect their treasury income, which makes up around 17 to 20% of their revenue. And this treasury income, how they earn it is basically they have a huge collateral balance. Like if you place money with SGX on the exchange, you have this huge collateral balance with SGX, and then they take this money and they put it back into like fixed deposits, and that's how they earn this treasury income. So with interest rates falling and I guess lower interest rates, they earn less, so this will take a hit. So it's around 20% of their total revenue. Yeah, so that's all I have. Yeah, next slide. Yeah, I think it's passed to Darren. Yeah, so that's all I have for the finance sector. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, so for REITs, this picture shows the strong rebound that REITs, the share price over the past 4 months is up almost 10%. So year to date is up almost already 9%. Because the first quarter was quite weak this year for the share price performance wise. Yeah, so we think the rebound will be sustained by further rate cuts to come. Yeah, next slide, please. Yeah, so for REITs, our top picks are Stoneweg Europe Stapled Trust. So first of all, see the title plus 15.5% reversion. So that was in the second quarter. So that was mainly because of the strong reversions at hard support the renewal for 20 years. And that is with their largest tenant as well. Yeah, so that is they had a rental reversion of more than 50%. So that is an exceptional new lease, rather renewal that they signed. So if you didn't know what Stoneweg Europe Stapled Trust is, they are European REIT with 104 properties. So they have 2.3 billion euro in assets, 1,000 plus leases, and over 800 tenants or customers. So most of their properties are freehold, and they also have an investment grade rating from Fitch and S&P. Yeah, so if you look at this chart shows the portfolio occupancy has been very resilient. So that's even through COVID, through the war, the Ukraine war and such. So portfolio occupancy is always remained above 90%. So we expect portfolio occupancy to remain stable and inch up towards the 95% towards the end of the quarter, the year, as they sign new leases. And most recently, they invested just 50 million euro into Ionics. So Ionics is a data center development fund from the sponsor. So there is an early stage one. So it's basically greenfield. So there's a lot of potential there. Yeah, and when they invested 50 million, just 1 week later, they did a revaluation of the whole portfolio, and the portfolio valuation went up by 50%. So that is a huge upside to NAV and the capital gain there. Yeah, so we expect this to capital gains to continue to come in as the portfolio gets developed and as as they revalue the portfolio. Yeah, and going forward, we also expect more portfolio valuation uplift. So we've seen the industrial and logistics properties, they've seen some valuation uplift over the past few years. But going forward, we are also expecting the office portfolio occupancy to show some uplift. So in the first 6 months, the office portfolio also they registered some slight valuation gains. That's mainly from the Hug Support lease that I mentioned, the with 50% reversions. Yeah, so we favor Stoneweg Europe Staple Trust because of the high yield, especially. So they're paying 8.5% yield, and given the fact that this 8.5% is based on the fact that the dividend yield forecast for this year is 13%. We think this 13% will be the base case really. I mean, will be the lowest or the bottom. So next year onwards, we're expecting the DPU to the absolute DPU to increase. So the yield will be even higher from next year onwards, especially from interest rates coming down and the fact that they've already repriced all their loans to current market rates. Yeah, so the yield is very sustainable, and for the rental wise, the top line, they continue to get CPI index rents every year, so the rents will continue to improve as well. So things are looking good for Stoneweg Europe Staple Trust. Yeah, next slide, please. Yeah, so next we have CapitaLand Escort Trust. So if you don't know what they do, they are a hospitality REIT or business trust where they have over 100 properties and 45, they operate in 45 cities. So, and globally. Yeah, so they have 8.8 billion in assets. Yeah, so for their organic growth wise, their RevPAR has been growing steadily, a low single digit, so we expect that to continue. And for inorganic growth wise, we are a bit stable there in the slide. So you can see that the past 8 divestments or over the past year, the divestments were all at premium over book value and premium over the most recent valuation. The most recent one was the Citadine Central Shinjuku, Tokyo. So that was at 100% premium over book value, and that unlocked almost 50 million in net gains. So right now they have about 250 million or even higher in undistributed divestment gains that are still sitting in the books. So that will be used to possibly pay off any or pay out in a situation where DPU will not hit 6.1 cents. So they've already so-called guided at 6.1 cents will be the bare minimum DPU for this year. Yeah, so at 6.1 cents, that is a 6.5% yield. Yeah, and on top of that, this CapitaLand Escort Trust, their portfolio is very has a mix of stable and growth income. So stable meaning master leases, which set us the base, and the growth income, which is from management contracts, where they'll get the upside from improvement in RevPAR and travel demand. Yeah, so that's for CapitaLand Escort Trust. Yeah, next slide, please. Yeah, so next we have City Development Limited. So we've seen the share price recover over the past few months. And that's mainly because of the asset monetization that is underway, we think. So if just to recall that earlier this year they announced that they divested South Beach, so that will unlock possibly over 500 million in divestment gains, net divestment gains. So that was one of the reasons why the share price rallied. And year to date, they have about 1.5 billion in contracted divestments. So we're expecting more divestments to come and more unlocking value. And that with that, we expect the price to book gap, discount the price to book to narrow. So now it's at about 0.6 or 0.7 times. Yeah, and operational wise, their property development segment is very stable and in fact it's doing pretty well. So the take-up rates for percentage sold for the recent launches and in the slide on the right. So the Ori 92%, Norwood Grand 85%, Casa 76% sold. So those are the most recent launches. So it's doing quite well. Union Square Residences is a ultra luxury product. So at 36%, that is very respectable and commendable given the fact that the ABSD at 60% performance is still in play. So that is a strong performance. Yeah. So all in all, we think with further asset monetizations for CDL, and we believe that the price to book gap or the discount price book will be narrow and to more fair numbers that we see over the past 15 years. They're trading at almost historical lows price book. Yeah. Next slide, please. Yeah. So moving on, to the small mid-cap space. So we are still looking for cheap and good. So basically that is after a lot of the small and mid-caps have already rallied. So we still think there is some value there as a lot of these small mid-caps get repriced higher. Next slide, please. Yeah, so this is a table of our small mid-caps that have yet to hit the target price. So we think there's a lot of upside here in a lot of the stocks here. So this is our PhillipEQDP hit list where we think that with more liquidity coming in, more funds buying small mid cap space, we think there is room for a lot of share price appreciation. And just to note that these shares here, they are not index. They are not in the index or STI index. Yeah, and they are small and mid cap only. Yeah. Next slide, please. Yeah, so next we have Prime US REIT, one of our topics in small mid cap sector, as well as for the REIT. It is like our aggressive play because we are banking on the US office recovery. So we've seen over the past, like since COVID, since the US office space has not been doing too well, especially when in 2022 and 2023 where interest rates started spiking. So as we see, the DPU here in FY24 was the lowest. That's because they're only paying a 10% payout ratio. But in FY25, the DPU we're forecasting it to increase to 62 cents. That's mainly from a 10% payout ratio in the first half and a 50% payout ratio in the second half of this year, which they've already guided that they will increase the payout ratio to 50% this year. Yeah, so right now they are trading at 0.4 times price to NAV. We think that gap discount to NAV will likely be narrowed with improving US office fundamentals and the fact that only 10.5% of the occupancy currently is, or rather only 10.5% of the occupancy that they've already signed or leased up over the past year or so has yet to commence any cash contribution due to the tenant improvements or tenant incentives like rent-free period and such. So as those start to contribute cash, we will start to see DPU improve, as well as the fact that the payout ratio will likely to increase as well. So the base case going forward, we are expecting at least a 50%. But FY26, if things get better, possibly they could raise the payout ratio higher than 50%, and that will definitely have some upside to share price when they do that. So right now the occupancy is around 80%. By year end, it's almost clear that we'll recover to 85% with a lot of major leases that are up and coming that are almost in the final stage of negotiations. And we're expecting it to improve to about 90% by year end 2026. So if you include all the rent free, because they are signing very, very long leases, like over 10 years. So usually you get 1 year rent free for every, you get 1 month of rent free period for every year you sign. So if you sign 10 years, basically you're almost getting almost a 1 year rent free period. So we're expecting by 2027 that will be a very will be an absolute will bang of a year, we call it. Will be a very, very strong performance in FY27 if things go according to plan. Yeah, so right now we are forecasting a 6.6% FY 2026 DPU yield. So that is based on a 50% payout ratio. Yeah. Next slide, please. Yeah, so next we have Takraw Corp. So this is, we call it a cheap mini conglomerate. So they are operating in many, many business segments. So we'll just roughly run through what they do. So first of all, they have a stake in Gem Life, a 16.8% stake in Gem Life. So Gem Life is a over 50s resort or MHE, which is a manufactured housing estates. So right now they own 16.8% of that, and that stake itself is already worth 250 million Singapore dollars. The current Takraw share price is the current Takraw share price of market cap is only around 200 million. So basically, if you count this Gem Life stake, we are getting the rest of the company for free. But of course, we have to have a conglomerate discount because they're doing so many different businesses. Yeah, other than that, they also have Japan. They invest in Japan commercial properties. Most recently, they divested one asset where they unlocked about 2 million in divestment gains. In India, they have an opportunity there where they invested a small stake, $6 million into land. So they are looking to develop that into a healthcare play or possibly some residential or commercial space as well. So that is in the very early stages, but there's a lot of room for growth there. For the lifestyle segment, so this is more of the kind of a recurring income type of income where they operate some stores in Greater China. So that is under the beauty and fragrance brand, mostly under the L'Oreal brand. And in South Asia, they are the distributors to DJI drones. And they also have some other Skytech and Skylab, which are manufacture components and some software as well. And for India, they are just started Nespresso. So they are the sole distributor of Nespresso in India. So that started operations late last year. So going forward, we expect Nespresso to scale up, and by the third year, we think that will be profitable. So for Takraw, they are also unlocking further value. They also have a 9.3% stake in the Beauty Tech Group, which is expected to IPO later this year. So, or rather later this month, in fact. So their Beauty Tech Group is currently valued about 17 million for their 9.3% stake. With the IPO, we're expecting them to unlock almost about another 10 million in value. So that is further upside, and that is for the inorganic growth part. So for the organic growth part, basically we're expecting the businesses in South Asia, like the DJI drones distribution and beauty and fragrance, to continue to grow. So over the past years, they've been growing both businesses by about 20-30%. So we're expecting similar growth levels for now as they continue to scale up these businesses. Yeah, so now we are forecasting a 2.5% yield, but it's likely to be higher as they pay out some additional gains, like from the IPO from the value that they get from the IPO of Beauty Tech Group as well. So they might increase their payout ratio or special dividends or something along those lines. Yeah. So that is for Takraw. I'll now hand over the time to Myanmar to talk more about other small cap picks. Yeah. Thanks.
Thanks, Darren. Yeah, I'll be sharing more on the small caps pick. Yeah, so firstly is CNMC. Instead of buying gold directly, we believe CNMC would be a high beta on gold, since like gold price already surged by over 45% year to date and reached like 3,900 some ish US dollar per ounce, and the market remained bullish on the 2025 outlook. In the middle of the heightened geopolitical tension and also very aggressive central bank purchases. Therefore, we increase our average selling price, and we believe average selling price will at least increase by 42% year on year, to 3,500 US dollar per ounce. And essentially, we expect earning to double even before ramp up in production, since any increase in selling price will flow down directly down to the bottom line. Not to mention that CMC has already increased their capacity, like daily capacity, by 60%, with the introduction of the new CIL facility. And therefore, we expect production for gold to increase by 45% year on year in FY25. And the stock is even further leveraged, as CMC has a good track record of paying out at least 30% of their earnings. And they tend to increase in the year of strong financial performance. Therefore, we expect share price upside to come from either increasing payout ratio or another round of special dividend in second half 25, and therefore translating to dividend yield of around 3% in FY25. Yeah, next slide, please. Yeah, so Zixing is a sweet potato company in China. And there's a lot of things to buy in China. Essentially, why do we like Zixing is Chinese government is encouraging food securities by industrializing the whole sector and also allocating land and resources. Therefore, we expect PATMI to increase at least by 40% in FY26. And Zixing is also trading at only 5 times PE, with more than 50% of the market cap made in net cash. And we believe PATMI, there are a few drivers to support PATMI growth. Firstly, we anticipate fresh sweet potato products, sales for fresh sweet potato to increase by around 27% year on year, which is driven by the expansion of the total cultivable area and also 20% increase in the cold storage capacity. And there's also a new factory for processed sweet potato, which has been completed. And we do anticipate this will boost capacity by 60% from second half 26 onwards. And they're also introducing higher margin products like the functional products, like sweet potato powder. Therefore, we anticipate sales for this segment to surge by 28% year-on-year in FY26. And last but not least, long-term or mid-term catalyst is expected to come from the Hainan Rejuvenation Project. This is a joint venture project with CITIC Construction, and that's the second largest company in China. With around 5 times, the cultivatable area in Hainan is around 5 times larger than the current one in Liancheng. And Zixing plan to generate revenue by duplicating the entire value chain in Liancheng, like essentially through sales of sweet potato seed, fresh and sweet potato product, and also animal feed. And therefore, we expect PATMI to at least double upon successful completion of the project. And the actual cash flow will start to kick in from FY27 onwards. Yeah, next slide, please. And for the small to mid-cap selection for REITs, we have L REIT. Yeah, we like it essentially because we believe DPU is likely to bottom out in FY26 after divestment of GEM office at premium. We expect a substantial amount of the proceeds will be used for debt repayment. Essentially, we'll lower gearing to below 35% range, and thus generating interest saving of around 15 million. And even though GEM office contributes to around 12.5% of the gross rental income, we still expect the income vacuum to be completely offset by capital top-up from the 9 million divestment gain, and also like higher occupancy rate at Sky Complex Mainland Building 3. And L REIT has just secured a new tenant, and therefore boosted occupancy rate by 15 percentage point. And currently, occupancy rate at group level is around 95%. And we like L REIT also because of its very attractive valuation. It used to trade at a premium above its book value, and now it's trading at more than 20% discount of its net asset value. Yeah, that's why we believe it's pretty attractive. And it's still generating around 6% of the dividend yield. And next slide, please. Moving on to recent initiation, we have like SIA Engineering. So we like it mainly because they're the key beneficiary of the rising MRO demand. And MRO upcycle are mainly from like 3 drivers. Firstly is growing travel demand and aging fleet. And last but not least, we have like delayed aircraft delivery as Boeing and Airbus continue to guide their FY25 delivery to be below pre-COVID level due to supply chain challenges. Yeah, and SIA Engineering accounts for more than 80% of the line maintenance market share in Singapore, and a combined 30% of the engine MRO market share globally. And therefore, we believe FY26 revenue would increase at least by 11% year-on-year. Another catalyst is coming from their stronger GV contribution from capacity expansion. Since Eagle and Sizzle combined, they are contributing to more than 50% of the total PATMI. And we expect GV income to increase at least by 22% year-on-year in FY26, and therefore translating to PATMI growth of around 18% year-on-year in FY26. Yeah, that's all for me. I will hand over to Eben for the rest of the small to big cap selection. Thank you.
Thanks, Mel. I'll be presenting on WeHer. Yeah, so for WeHer, they have a construction segment and also worker dormitory segment and also some property investment segments. So going forward for the next few quarters, we do expect the recurring revenue and PATMI to mainly come from construction as well as worker dormitory. For the construction, as you can see in the left-hand side, their order book spiked from 263 million to 629 million. And this is because they won 2 additional BTO contracts. And these contracts will last till 2029. So we do see a very healthy visibility going forward in the construction segment. As for worker dormitory, they recently opened 3,100 more beds in June, which is about a 20% increase in bed capacity. And by the end of fourth quarter this year itself, we do expect an additional 7.3 thousand beds coming up in their Pioneer Lodge worker accommodation. So in total this year itself, there will be an increase in 66% of worker dorm bed capacity. And we do believe that this will support the revenue and PATMI growth for WeHer. As for their PBSA fund, recently at the start of this year itself, they sold out their Fund 1 and they received 300 million in net proceeds. So this boosted their balance sheet from about $150 million net debt to currently about 30 million net debt. And there's still more proceeds expected to be coming in. So they have a very healthy balance sheet, and they are also Fund 2 is currently operational, and we do expect going forward, WeHer has an additional about 230 million worth of assets to be sold, and we do expect some special dividends to come from the sales of those assets as well. But we don't think it'll be so soon. Maybe from the second half of next year onwards. Moving on to Franken. So Franken provides critical components for semiconductor equipment makers. Their main customers are ASML and Applied Material. So if you can see, the revenue growth of ASML and Applied Material shown in the blue color line is very closely correlated to Franken's revenue growth, which is the red color line. So going forward in the next quarter itself, ASML and Applied Material provided a combined guidance of an additional 14% year-on-year growth in revenue, and we do think that this is positive for Franken, because Franken provides a very critical component for ASML's expansion into Asia. However, you may realize that there's a slight deceleration in terms of the revenue from the guidance itself. This is because ASML and Applied Materials' main customer, TSMC, provided a softer CapEx guidance because of the uncertain macro environment. So their TSMC's orders, there will be some order volatility. However, for next year itself, we are still positive in terms of the demand for semiconductor equipment chips. So for Franken, another thing is their valuations is attractive as well. They are currently trading at about 15 times PE, as compared to its peers average of about 25 times PE. So we have a buy call on Franken with a target price of 1.76. Moving on to SoyBuild. SoyBuild has a large segment in construction of private industrial buildings, and about 20% of their revenue comes from precast components. So they supply precast components to HDB BTO projects. And this is the industry snapshot of the completed BTO flats over the past 20 years. The Singapore government provided a expectation that 55,000 HDB BTO flats to be built over the next 3 years. So on average, that is about 18,000 flats, and it is about 20% higher than the 14,800 flats on average yearly. So we do think that this is a very positive guidance. And this 55,000 flats completed guidance provided by the government is also 10% higher than their previous guided number, which is 50,000. So they increased this guidance because of the HDB backlog coming from COVID. And for SoyBuild itself, we are positive in their precast component business, because for the new HDB BTOs being built, they are built using precast components. So we do think that SoyBuild will benefit from this trend itself. Currently, SoyBuild is trading at a cheap valuation of about 9 times PE compared to its construction peers average of about 15 times PE. Yeah, so we have a buy call on SoyBuild and target price 3.41. Moving on to the next counter, Penn United. In the most recent, for those who are unsure, Penn United has a 40% market share in ready-mix concrete. And for the most recent July data itself, ready-mix concrete volume inched up 7% year on year, and this is the highest gain since last year September itself. And we do think that this increase in volume is because of the large projects starting to kick in. For example, the Terminal 5 construction, the HDB BTO projects, expansion of LTA MRT lines, as well as integrated resorts coming up. Yeah, so we do think that this is positive for Penn United, and we have a buy call and target price 1.34. Yeah, that's all for my end. I'll hand over the time to Paul. Thanks.
Yeah, thanks, Jiban. So I'll just follow up with two small cap names. So we have TeleChoice. I think we already presented this last week, which we just initiated, and I think the commentaries were correct. The feedback that the volumes are thin, and we totally agree. And of course, we are usually very careful when we cover stocks where the volumes are thin. So the company is basically turned around. So the first bullet point, they are doing 4 PL contracts. Essentially, they are responsible for all the handphone requirements of U-Mobile. They will finance it, deliver it, and also manage the whole inventory plus after sales service. And therefore, they will collect a fee on it. This 500 million contract over 3 years actually allowed them to turn around from a loss to a profit over the last 12 months. The second thing that is turning around for them would be their network engineering. So the headcount has doubled to 4,000, and we think the move towards data center power supply will be critical. And that's because part of their ownership is actually owned by ST Telemedia, which operates more than 90 data centers around the world. And of course, ST Telemedia is part of Temasek. So we maintain a buy and with a target price of 215. Next slide. So for Geo Energy is a co-producer in Indonesia. So our recommendation is because we think they are turning into an infrastructure provider. So if you look at the chart here, they are going to spend $170 million to build a hauling road and also with a jetty. So once that is completed, it is now 30% fully completed or maybe more. And this should be completed by middle of next year. So they're spending $170 million. So assuming the completion is done, you will see from this mine, the TRA coal mine, production will jump from 2 million this year to 12 million by 2027. Because this road is a 50 million capacity road. So that's one part of the earnings driver. The second part is toll revenue. So toll revenue is basically to rent out the road to other coal mining companies around the area. So this, assuming, depending on coal price, the value of this could be $6 to as high as $10. So, and this is a very high EBITDA business. So even you, assuming you put a 0 towards the 25, 250 million, the EBITDA is hardly any, running cost is hardly anything. So it's quite a huge EBITDA that can come from this toll road. And also the third part is a river transshipment. So this is new. They just made an announcement to acquire tugs and barges. So the road doesn't end in the sea, although the blue line here shows it actually ends in the river. So from the river, you actually have to transport it towards the sea where those large bulk carriers will come and collect and transport. So that part, they are also looking to generate revenue from this. The real short-term event, if it happens, is that if they have a asset monetization event, so rather than wait for this to be operational, they could actually sell some stakes into this whole infrastructure business. This will give the big re-rating in terms of the value of this asset and also help reduce gearing. So we maintain a buy with a 59 cents target price. Next slide. Next slide. So this is just our model portfolio for the month of for the third quarter. If you read our strategy report, we were up about 27%. You see 19 here mainly because we took out Propnex, which was up about 117 for the 3 months. We took it out mainly because it exceeded our target price. The second stock that we took out was Semcor Industries, which we are just a bit concerned that the second half results might be weaker than expected because electricity margins might be softer. What we added was Prime US REIT and Singtel. So for Prime US REIT, as what Darren has mentioned, we are adding it because we are making I guess a leverage bet that the turnaround in US office will happen. So assuming it hits the 90% occupancy by 2020 by end of next year, you will get this really positive snowballing effect where cash flows will be higher, dividends will be higher, and then of course valuations will also be higher. So we are making I guess a more aggressive bet on the whole US office sector turnaround. Next Singtel, we'll talk about it later. The one that helped the performance for the third quarter was of course property like Popnex, City Development, and some of the construction names, including Beher and small cap names like Geo and so forth. Next slide. This is just for illustration. This is the performance. I think we took it out since 2018 when it was kind of started. And then the SING here is basically the index, the ETF index. Oh, sorry, the index itself, and this is the model portfolio, excluding dividends. Next slide. So in terms of Keppel, we still have a buy call. So we still like Keppel because we think there will be two parts. Initially, there will be two parts to the story or the share price. Firstly, we think earnings can recover in next year. That's because they're going to have a new power plant middle of next year, Keppel Sakra Cogen. And there will also be the completion of the whole office that is being leased out. Right now, the latest commentary was about 50% lease. And the third is the whole Bifrost cable. They don't own it in the balance sheet. This is part of a fund, but they will get some revenue from the operation and maintenance. Of course, the bigger revenue is if you sell it in the fund, but I think that will take a longer time. The second part of the story will be the monetization. So they're looking to monetize 14 billion of assets. This is excluding the whole M1 that was recently disposed and pending approval. And of course, this will lead to special dividends. They're also doing a 500 million share buyback in the meantime. The third thing is that assuming all this is wrapped up, then what will happen is that you will have a pure asset management company like Brookfields. And no such asset management companies, the valuations can go as high as 20-25 times. But that's assuming everything is done and so forth. But in the meantime, you're going to get these two share price drivers. Next slide. If we move on to Singtel, we added into the model because of the recent share price weakness. It was a tragic event. I think the failure of 000 did cost some lives, and of course it's tragic. But operationally, we think it is still strong. The main profit driver or even the whole share price driver has been Bharti Airtel, which is if you look at this green line, so this is the mobile price of Bharti Airtel. So this has actually jumped from 100. It's up 65% the last I guess 4.5 years. So what has happened is because of the consolidation, so they managed to drive prices up, and this should continue. Especially with their competitor coming up for listing. Actually, Australia is also performing well. You can notice the red line, the prices actually started to climb. Likewise for Thailand, the areas that is weak is Indonesia, the blue line, and also, of course, Singapore, the orange line. More critical is that not only will earnings grow, the cash flow, Bharti is going to raise their dividends. So this will also benefit Singtel through dividends. Next slide. So in conclusion, in terms of the macro picture, we actually think that the operating environment is positive for equities. What you get is the end of stagflation. That means we think inflation will be starting to trend down. Then you get the rate cuts, and then you get a resilient growth. It's not going to be really strong growth, and we do not want the US to be too strong too. So it's just like not too hot, not too cold. So this is the potent mix for equities. Then for Singapore itself, you're going to get, like what mentioned, a few rounds of liquidity injection. Like we mentioned in our weekly note, we can stocks can be cheap forever, but what you need is how to realize the value. So we think the value realization will come from, of course, EQDP, which we think at most is only 500 million of the 5 billion. So there's going to be 9 times more coming up. And if you notice, the market really rallied in July. I forgot to mention when they mentioned the allocation of the 1.1 billion. That's when the market rallied. So you should expect more news of the actual allocation to fund managers. There's also, of course, also EQDP plus. So the fund managers also have to raise third-party capital, and this will, of course, be an additional source of liquidity. And of course, EQDP plus Temasek. I mean, because DBS is going to do share buyback 3 billion, Singtel 2 billion, Keppel also doing share buyback 5 million. So all these are going to be multiple rounds of injection into the market. So we think there'll be a major re-rating and valuation expansion. These are the sectors we favor: REITs, banks, property, and small caps. Okay, thanks everyone for listening. And no, sorry if you've already attended the Saturday sessions, but we normally do a summary of it over the following Monday. Sorry, we can move on to question and answers. Thanks everyone.
Thanks, Paul. I guess I'll start taking. So there was a question on Apple. Let me just find it. Yeah. So Helena, would you revise your Apple target price given good outcome of the latest iPhone launch? Yeah, it's just an update for those who's not following the iPhone launch result. So the iPhone 17 and 17 Pro, the result is actually doing much better than our early projection. So they haven't really released significant number, but they did ask some suppliers to increase the production of their base iPhone 17 by 30 to 40% just to meet up with pent-up demand. So a few reasons that they're doing well is we do think they do the new iPhone 17, they do pack some good features upgrade. And at the same time, because it kept the entry price exactly the same as iPhone 17, and also it came with a bigger storage. So with all the improved features, a lot of people think it's just a good deal. Like, why wouldn't you upgrade when it's the same price? But no, also worthy to point out is when they launched it, their spotlight item was actually iPhone Air, but iPhone Air appears to be lagging behind a little bit because we think the reason is it has lower specs. It has a single lens camera. It has also a smaller battery, which makes it less appealing. If they try to make it a lower end model, maybe it will gain some traction, but because they're trying to price it as a premium model, so when it's a premium pricing came with lower specs, so it's not really attractive to people. And also because iPhone Air is not releasing markets like China, so that kind of make the entire demand evaluation not very complete. But overall, to answer your question, whether we want to adjust our target price, I think for now, not so much because we continue to see very limited evidence of a strong upgrade cycle. Yes, they do have some feature improvement, but it's still a fact that they're lagging behind their peers in AI. Their AI initiative is only going to come in 2026 when they delayed their Siri upgrade. And the pricing right now, because they didn't change the pricing, which is good for the short run, but that also kind of implies that they are absorbing all the tariff-related pressures and the higher production costs. So that's likely going to weigh on their profitability. So right now we still remain pretty cautious. So I hope that answers your question. And I saw another question on Netflix about Elon Musk. Let me just trying to find it. Is Elon Musk called to cancel Netflix significant enough to affect its fundamentals? Netflix share price has dropped quite a bit because of Elon Musk calling out to cancel Netflix. But the drop we think it seems more to be sentimental, like short-term reputation risk. Definitely in the short term it will be affected because it will face subscriber loss because some viewers, especially Elon Musk followers or those influenced by the campaign, they will try to cancel their subscription. And also potential new users, they might decide not to join due to reputation damage. And definitely content creators, advertisers, they might try to shy away if there's any damage to the brand image. But to answer your question, is it significant enough? I lean more towards no, because I don't think it will materially affect their core fundamentals. The Netflix right now still maintain its leadership in streaming. It has very noticeable pricing power. Every time they increase the power, it doesn't really affect their subscription growth. And also their margins are still improving. Netflix right now, compared to their closest competitor, which is Disney, they have more than 35% more membership than Disney, and they monetize it 2 times better. And right now, if you really look at the total TV viewing, Netflix do take less than 10% share of the total TV viewing. So we do see there's a lot of potential for them to grow. So the runway is pretty big. Yeah, so I guess to answer your question, not significant enough. I guess that's pretty much from my side. I'll pass my time to my colleagues. Thanks.
Yeah, thanks, Helena. Yeah, I'll take some questions. Ian asked some questions about the banks. I think I probably answered it. No, you might have asked it before I started my presentation on the banks. But his question is any reason why sudden rebound of DBS past week? I thought all the good news already priced in, especially on the clarity of dividend payout policy. Yeah, I think it might just be because the results are coming out soon, the dividend payout is also coming out soon, so that might be one of the reasons why. Yeah, but most of the good news has already been priced in, but there could be a possibility of, further dividend increase, going into, because they will have to sort of refresh the dividend policy. So there could be further news, I guess, coming from DBS. But of course, everything is quite subjective for DBS, as in like the dividends policy part. What's your take on OCBC and UOB, which are lagging? Any further upside, downsides on mid to long term? Yeah, so I did go through earlier, OCBC and UOB. Mainly for OCBC is that, their dividend policy is the weakest, I guess, amongst the three banks. And also they are not giving really much forward guidance on where they're going to go with their capital return policy. Their China, Greater China sort of the Greater China plan that they have is still ongoing, right? They're still trying to take all the inflows, more like outflows from China to Singapore and to Asia. So that's what they're trying to do still. For UOB, it's also really their fee income is not growing as fast. It was lower than expected, because their customer base is tending to lean towards the more prudent side, right? So their plan to really expand greatly into wealth management is a bit slower than expected. And yeah, I guess for all three banks, maybe one thing I could like to add on earlier, which I couldn't. The thing is that they have a lot of management overlay, right? Or they put on a lot of allowances that they didn't need to, because they not didn't need to, but they didn't had to put aside, but they're just putting it on just to just in case of a black swan event, right? So they were really stuffing piling on the provisions. And all three banks have actually held on to this since 2020, right? Since COVID started to now. And they haven't released much. So that's one of the main, I guess, upsides we could see from the banks is, when earnings are, or like the net interest income or fee income isn't growing as fast as they would like, they could sort of inorganically, boost the earnings by releasing or writing back some of these excess provisions that they have held on for, I guess, the past around 5 years now. And I think DBS is the only one that has sort of publicly announced how much they have in terms of management overlay. It's 2.6 billion. Right, so there's this huge amount, that if they were to release maybe 200 million or so, 300 million every quarter, it will still take them quite some time to release everything, right? At least, maybe another 8 quarters, so 2 years to release all this. But of course, we're not going to expect them to release all of it. But some of it just to help to boost the earnings in order to maintain especially for OCBC and UOB, because their dividend policy is based on the floating 50%. Right, just in order to maintain the DPS or dividend yield. Yep, so the TP for the Singapore banks is 52 for DBS, 1650 for OCBC, and 3460 for UOB. Yep, I think there's one or two more questions on DBS, right? They're asking, it's really trading above 53, and that current share price, target price is 52. Am I overly conservative, or am I going to be adjusting my TP? Yeah, we usually do it every quarter when they release their results. So in terms of overly conservative rise, the earnings are really not gonna go up, right? The only thing that's bumping up this the share price is the dividends, because earnings will be flat for DBS as well, right? So it's not just affecting OCBC and UOB, but earnings for DBS will also be flat. The only thing that is really bumping it up is the fact that they are willing to pay out way more than the other two banks. So that's the main difference for DBS. And yeah, when will we be adjusting TP? Yeah, we do it every quarter. Yeah, one on SGX here. For SGX, do they not diversify their treasury income into MMF, money market fund, or other higher yielding instruments instead of just FD? Yeah, that's a good question. So to understand this, you must understand firstly, where does this treasury income, how do they earn it from, right? I mentioned it briefly earlier. It's really from collateral balances. So this is customers' money that they are holding, right? So in terms of when you're holding on to your customers' money, you need to be quite sure that it's safe, right? Because firstly, it's I guess you must abide by the regulatory bodies as well, right? So in case that if they need to withdraw the money, that this money is there, right, and the value isn't declined. So in terms of money market fund or other higher yielding instruments, yes, they are extremely low risk, right? They are low risk, but there's not really, I would say, it's still higher risk than a fixed deposit. The value can still decline, right? That's the reason why majority of it is placed into fixed deposit, where firstly it's extremely low risk, right? So you are guaranteed the return plus the capital, and also they are able to better, I guess, forecast or guide where the interest income will be in terms like 1 or 2, maybe 1 year. Yeah, because they put it in about 3, 6 months and 1 year. So it's a bit short. So it's always revolving. So that's the reason why they put majority of it into a fixed deposit instead of like what you said, money market fund or other higher yielding instruments. Mainly because of where they can see in the future, and also because of the the guaranteed base plus principal plus the interest. Yes, I think there's one more here. I saw it earlier. Yeah, because someone asked about SGX also. I'd like to understand more on SGX. It seems wildly overvalued and also gone beyond my TV. Yeah. So what's your rationale other than funds pivoting to Singapore? And why do you think this is a sell price what do you think is a sell price as the yield is also not so attractive? Yeah. So I'll cover a note about the rationale. Besides the funds pivoting to Singapore, that's one. Trading volumes are also high. Volatility is one of the main reasons as well, right? That will benefit SGX. And the last point, which has been picking up slightly recently, slowly, I guess, but not extremely aggressively, would be the number of listings, right? The IPOs. So it has picked up definitely over the much better than the last 2 years. So that's one of the tailwinds that we could see that could benefit SGX. So they do have quite a few tailwinds to benefit them. But then again, the major headwind, or I guess the only headwind that they could face, is that lower treasury income, which it's not as widely talked about, because but it still makes up about 20% of their 17 to 20% of their revenue, which is quite a big number. Okay, I think let me look through again. I think that's all for me. Yeah, that's all for me. So I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. I can take on some questions. First one, is micromechanics a good value play? Yeah, I think so, because micromechanics, they are pivoting to the front end side of the semiconductor value chain. So front end typically has a much larger total addressable market than back end. So front end refers to like your lithography, your deposition, your etch processes. So pivoting to that is a good step. It's a good direction, and they also have facilities in the US itself. So with Donald Trump coming up and trying to spur more domestic manufacturing, they are seeing more customers also going to them to manufacture in the US. So right now, micromechanics, their price to earnings is about 18, compared to its peers is about 25. So they are still trading at quite a significant discount. So I do think it's a good value play. Next question, why did AEM drop so much despite denying allegations? Yeah, so I went to search it up. AEM experienced some patent infringement allegations from its competitor. I do think that it dropped so much also because I think the past week it rallied a lot because of the news from Intel acquiring, I mean, Nvidia investing in Intel. So I think there's a lot of optimism in AEM stock because of Intel's boost in share prices. But I do think that a lot of it is hype because people will naturally link AEM to Intel's good prospects. However, I do think that it still takes a few quarters before we can determine whether Intel can really take back market share from AMD with regards to the loss in market share in CPU. And yeah, so I think this strong rally in hype caused some profit taking, especially after a bit of a negative news. And I don't think this news is very negative because previously the same company has came in with a lawsuit to AEM and they settled. They have a settlement of about 20 million, which is very small for it's only about 3% of their market cap. So I don't think that this news warrants such a big drawdown in terms of their share prices. Yeah, but hopefully it gives you some insights. Let me see. There's a question: should applied material be avoided after the bad news? Yeah, so applied material, there's some news that it cannot receive export licenses for its equipment to China. And they also mentioned that their key customer, which we believe is TSMC, has some order volatility to them. And I think this is consistent. I think this second piece of information about TSMC's order volatility is consistent for all semiconductor equipment players. So I do think that ASML and Lam Research will also be affected. But however, this export license news is unique to Applied Material. So this presents an additional risk compared to other equipment makers. And I think Applied Material hasn't been experiencing very strong growth as compared to ASML and Lam Research, because ASML and Lam Research experienced about 25 to 30% year-on-year growth for the past 2 quarters, whereas Applied Material only experienced about, I think, less than 10% year-on-year growth. So in terms of growth prospects, I do think that ASML and Lam Research has better growth prospects as compared to Applied Material, and their equipment has been selling through. For example, ASML's EUV equipment has been gathering quite a lot of generating quite a lot of revenue growth for ASML. Yeah, so I do think that a better pick will be ASML and Lam Research as compared to Applied Material. Yeah, within the semiconductor equipment space. Yeah. There's a question: does Centurion or the REIT hold better assets? Yeah, I think if you just purely look at the current assets that both entities hold, then the REIT will hold the better asset because Centurion spun off their purpose-built dormitory into the REIT itself. So those purpose-built dormitory is sort of like a permanent kind of dormitory. They have lease periods of more than 50 years, and currently in the Centurion parent company itself, they are holding a lot of the quick-built dormitory, which are dormitories built during the COVID period. So I think one of the assets is expiring end of this year, and a lot of them are expiring end of next year itself. However, the story for Centurion parent company is still that it has a very strong balance sheet now. It continues to hold about 35 to 40% stake in the REIT itself. So it has a very significant stake in the REIT itself, which will flow to their bottom line. And the management team is also the same. So with this strong balance sheet, we do think that based on the management team's track record, we think they can go find other opportunities earlier. Yeah. So that's the story for the parent company. In terms of which one holds better asset, it will be the REIT. Yeah. Do you have a view on add value tech? This stock seems value with a lot of contracts. Yeah, I think it's is a stock with exposure in interesting tech areas. For example, they provide some equipment for GPS navigation. So for example, the satellite imaging, and also uh, uh, what else, like radar, I think. Radar antennas, communications, and so on and so forth. Yeah. I mean, with regards to the competitive landscape, I'm not very sure. Yeah, but I think in terms of their technology, it's still quite relevant. Yeah. So I can't give you a very good response to that. Next question. Hi, what's your view on CSC Holdings? Yeah. Yeah, so it is a company in the construction sector. So they specialize in foundational pilings. So for example, before a building is being built, you need to clear the land first. You need to build piles to strengthen the foundation first before the building can be built on it. So that is what CSC is doing. They specialize in the foundational piling. And my view is positive for CSC Holdings, because recently they has turned around from a negative PATMI to positive. And it's also because they are taking on more projects within the construction sector. And their projects is typically quite short, like for example 6 to 9 months. So there will always be projects coming in, because they are consistently bidding for projects. I think the start of this year, I talked to their management. They are operating at about close to 100% utilization, machine utilization. So they are still a very small company. But I think the good thing is there's visibility as well as projects coming in. Yeah. Is Cole Brother Echo Engineering a good construction stock? They get government contracts from LTA, Sports SG, and Changi Airport. Yes. I didn't get a chance to meet Cole Brother Echo Engineering's management. But I took a brief look at their financials. They are currently net cash, so that's a good thing for a construction stock. And I think their PATMI also turned around for the most recent first half results. Yeah, so I think based on what you mentioned, if they get government contracts, it is quite positive. But generally, government contracts will present a lower margin for construction companies. Yeah. What's the NAV and PE for Centurion REIT? I think you're referring to NAV per share. If you're talking about NAV per share, it'll be 0.88. So currently Centurion REIT is about $1.03. So it's a slight premium to their NAV per share. Based on PE, there's no historical PE because hasn't been a quarter or half yearly yet. But my estimate from the parent company, their PE is about 5 times PE. This is because there's a lot of fair value gains from the property itself. So if you adjust out the fair value gains and one-offs, their PE will be about 15 times. Yeah. Yeah, so it's a question why LHN, sorry, why LHN rally on Hollywood news, but Centurion dropped so much on the REIT news, opposite outcomes. Yeah, so I think the timeline for these two companies, if I'm not wrong, is different. Because Centurion, ever since they announced that they are going to spin off the REIT since January, the share price has rallied about 80% since the news. So I think both of these companies has rallied from news of the REIT spin-off. But the reason why Centurion dropped very recently is because it only dropped after the REIT has spun off. So the REIT spin-off about September 24th, if I'm not wrong. Yeah, so I believe that some shareholders had made the decision to sell Centurion and buy the REIT itself to have some capital to invest in the REIT. Yeah, so that may be the sentiments on the ground. Yeah, but that's just my guess. Yeah. Yeah. I think there's a question, Franken will be affected. Not sure what are you referring to, the export license to China? If you are talking about that, Short-term wise, there may be some volatility in terms of their net profit. But I think we have mentioned in the report as well. Currently our outlook for Franken is still positive because the overall demand for semiconductor AI chip is still huge. I think it's just that the next half itself, PetMe, we do think that it will be stable. It won't experience the kind of explosive growth, but it can be maintained. We do believe, yeah. My view on Hong Leong Asia, if it rises above all-time high. Yeah, so my view on Hong Leong Asia is that in the short run, their ready-mix concrete segment may not perform as well as Pan United because some of their small land leases has expired. In order to consolidate the ready-mix batching plants into the Jurong Port consolidated batching plant. So in the short run, their short-term supply of ready-mix concrete will be affected. But ready-mix concrete only makes up about 20% of their overall revenue. So in terms of their China Yuchai segment, which sells diesel gen sets in China as well as Southeast Asia, that segment has experienced quite a lot of growth in the most recent earnings. And this is because they managed to sell a lot of diesel gen sets, which are being used in hospitals as well as data centers. Because imagine a data center with electricity being cut off, or hospital with electricity being cut off, they are very critical to maintain to keep the lights on running within these facilities itself. So diesel gen sets has been garnering quite strong demand for Hong Leong Asia, and yeah, so that's why I'm still positive in their China Yuchai segment, but not so much for their ready-mix concrete segment in the short run. Yeah. Yeah, I think I'll hand over to my colleagues for now. Yeah, thanks.
Yeah, thanks, Ignan. Yeah, let me take on some. Is it worthwhile buying Capital DC rights given the price only started to spike recently? Can the price sustain above $2? Yeah, so if you're an existing shareholder, then you can buy the rights. So in our view, we think this rights issue is kind of positive because they're using it first of all to fund the Japanese the Japan DC, which has a cap rate of about 4, and the cost of that probably around low 2, so they are getting a positive carry of more than 1.5%. So there is some upside there. Even though the lease is I mean, this Japan data center will probably form a very stable base for their portfolio, as the lease is 15 years and only 1% rental escalation. So for KDC, their Singapore portfolio will still generate most of the alpha with the fact that the rental reversions can like we've seen the 50% reversions. So elsewhere, reversions probably will be around this similar low single digit to mid single digit levels. So they're using it to fund that, as well as the AEI at SGP 8. So that is also we take a so sorry, yeah, so the SGP 8 there, so that they're going to activate one data hall. Yeah, so they are looking at about some 2.2 to 3% rental escalation for that, and probably around slightly over 10% ROI for that as well. Yeah, so we view that positively. And yeah, there's a question whether can the price sustain above $2? Yeah, we think so. Our target price is $2.33. So yeah, and if just did some rough calculation, the theoretical price or the TERP is about $2.35. Yeah, so that is also that is above our target price, in fact. Yeah, so the rights issue is 80 to 1,000. Yeah, so in our view, if you're an existing shareholder, you should subscribe to the rights. at $2.24. If not, you'll be diluted in that sense because everyone else will subscribe, and if you don't subscribe, you'll be diluted. Yeah, so our view is if you're an easier to subscribe. And yeah, there are quite a few questions on that, so I hope that answers. Stoneware REIT. It's now Stoneware Europe Stapled Trust. Better to buy Euro or SGD share. If buy the Euro share with the dividend in Euro too. Yeah, so we buy the Euro share, the dividend will be in Euro. And for that, we recommend you to buy the Euro share, the Euro counter, because it has more trading liquidity and more volume as well. Yeah, so it's easier to enter and exit if you buy the Euro share. So that is the one that we recommend. Anyway, the income that Stoneware REIT gets also 91% is in Euro. So yeah, we advise, or rather we recommend that the Euro counter. For CDR, the share price seems to be boosted by recent divestments. Is this a good sign? Yeah, so these recent divestments, especially the South Beach one, definitely is a good sign where they unlock about 500 million in divestment gains. So possibly going forward, they are likely to announce more divestments upcoming. And this year, they've already year to date 1.5 billion. So as they divest more and they unlock some more value, we believe that the discount to NAV will be narrowed. So earlier I showed that in the chart, right now they're trading about 0.7, 0.6, 0.7 times price to book. So we think this likely to be narrowed with more future asset monetization initiatives. Yeah, so that is a good sign for us. You mentioned US office recovery when you shared Prime Outlook. How would you see Manulife US REIT? Yeah, so for Manulife US REIT, they are facing other issues. So first of all, is their gearing is still above 50%. If I'm not wrong, it's 56%. So that is still way above the MAS leverage limits of 50%. And on top of that, they have a recapitalization plan. So part of that was to divest 328 million US dollars by June. So they've already missed that. They still need to divest another 70 million if I remember correctly. So yeah, that is there's still in a so-called recapitalization or a so-called a default-ish type of situation. Yeah, and operationally wise, their portfolio, the occupancy is at 60 plus 70%. So because as you all know, it's very important to have a very strong balance sheet for US office REITs. So because when you sign leases, that the landlord is expected to have some tenant incentives and tenant improvements. Like for Prime, for instance, they have a strong balance sheet with a strong cash pile. So they can use that to attract tenants, like give them some incentives, but at the same time sign very long leases and at good positive rent reversions. So for Manulife in that situation, since they are already at their leverage at 56%, the balance sheet is a relatively weak compared to the other two REITs. So it's also much harder for them to secure new leases, and especially not to mention leases that are positive rent reversion and longer term leases. Yeah, so for them it's still quite challenging for Manulife. First of all, for them to recover, they definitely need to bring their gearing down. So likely another asset sale. I can't really say the amount because I can't really guess the amount. But if you ask me, I think probably they're looking at almost another 100 million to at least hit the 2028 that was part of the plan. Yeah, so once they use that and they start to repay their debt over time, um yeah, the recovery might then come after that. But for now, it's still very challenging for Manulife US REIT. But for the other two, Core and Prime, they are located in better jurisdictions, better geographies in the US, where the demand is also higher. Their assets was better located. Yeah, so for them, likely we'll see a recovery earlier as their balance sheet is still strong, and which was why also Prime they have had the confidence to raise to be the first one of the three to raise their payout ratio to 50% because of the income visibility that they see upcoming from the leases that have already been signed but have yet to contribute cash. Yeah, so so that is just my take. Yeah. Can you provide your insights on CLI? What is your thesis SP matrix quite high? Yeah, so ours we have a 16x multiple, so you think that is not high. Normally for pure fund manager business, 16 to 20 is in fact quite a normal type of range. Yeah, but for CLI, we definitely favor them. So for their very recurring fee income business, so we've seen that improve year on year, like all the different pillars, like the commercial management, the lodging management, as well as the listed funds and private funds management that continues to improve year on year. And they're also looking to hit the 200 billion target by 2028. So that is still on track. And yeah, the most recent development was the C REIT listing, the CLCR. Yeah, which we saw like over 200 times oversubscribed. Yeah, so that was it's another platform for them that they can use to divest their Chinese assets. So the thing that was kind of hindering or affecting their share price was, in my view, was of course other than the interest rates. So high interest rate of course will affect their business. Another one was their China exposure and the China balance sheet assets that were not performing well. So over the past few years, they've been trying to divest that. So yeah, with this new Chinese platform, yeah, they can likely just over time inject possibly some of these about we believe 2 to 3 billion more Chinese assets that are on their balance sheet. They can divest these into the REIT as another platform and maintain a small stake, and at the same time continue to earn the fees. Yeah, or even divest these to their China funds, private funds as well. Yeah, so that is the recovery story for CLI. Why is Takra trading below its actual value? Yeah, so for that, we think possibly a few reasons. One of it is the low exposure to investors. So probably quite a relatively unknown share. So not a lot of investors know about it. So that's one of the reasons as well. And along with that is also the low trading volume, low liquidity of the share as well. Yeah, so that is why we think Takra is trading at such a steep discount. Yeah, like I mentioned, just the Gem Life stake trading 250 million Singapore dollars, and the market cap for Takra is just 200 million. So basically, for just a stake alone, you're really getting value, and not to mention the other business segments that they actually operate in. Yeah, so it is our value play for that. Yeah, and hopefully with more exposure and the liquidity money coming in, yeah, investors start to see the value in that, and then likely the share price will start to show its actual true value. Compare LREIT and StoneREIT, which is the better buy? Yeah, so both not really a good comparison because of the fact that the assets, one is logistics and in Europe. I mean, LREIT has one asset in overseas as well. What is just slip my mind what the asset was. Yeah, but it's not really a comparison because one of it is in logistics, like industrial, and like 60%, and then some office space in 30+% office. LREIT is more of retail, which StoneREIT only has one asset, and it's very it's not even It's a very small portion of AUM, like less than 1%. Yeah, so it's not really a good comparison to compare these two REITs. As their business is different. Oh yeah, the asset is Sky Complex in Italy. Yeah, we just saw a new lease signed as well. Do you think KDC is very much over dilution in its shares? Just not too long ago, there was an exercise to raise a huge amount of funds. Then now again, this rights issue here to raise fund another time looks like endless to it. Seeing all this making me dizzy. Sorry. Oh, okay. Yeah. So there's this a long, not sure whether comment or question. Yeah, but so the difference between okay, so recently you're right that KDC they issued many shares previously, like cause they did many acquisitions, especially the last year, the SSP 7 and 8. Yeah, that one came with a huge private placement. So existing shareholders, you couldn't get rather you couldn't get a share in that, but there was a small preferential offering as well. So basically, back then the existing shareholders definitely were diluted because of the fact that there was a huge private placement. But this time around, at least, because the capital the raise is smaller than the previous one, where they use the funds to acquire SUP 7 and 8, and as well as the fact that it's a pure rights issue. So if you are existing shareholder and you subscribe to the rights, you will not necessarily be diluted as compared to previous time where they had a huge private placement. Yeah, but from our view, the proceeds of the funds, like example, the one that they used to acquire SP7 and 8, that was accretive acquisition, and similarly to this one as well, is 2.8% accretive to DPU, and if you include the AEI on SCP8, it's likely the DPU accretion would be above 3%. Yeah, so these are the good pluses, but yeah, you're right that endless fundraising, but that is also a good thing. That means they are having some inorganic growth and they are looking for opportunities to continue to grow and expand the portfolio. Yeah, but along with that, of course, they have to raise more funds and which is why they had to do the equity fundraise. Yeah, I think I'll hand over to my colleagues for now. Yeah, thanks. I'll type in the answers to some other questions. Yeah, thanks.
Kwame, you want to take some very quickly? I think he's answering typing. Oh, okay. Yeah, thanks. Sorry, let me turn on. Yeah. I'm also trying to type in as many as you can because team for me would be REITs definitely. I think with sorry, the internet's a bit big. So for me, the two sectors that we would like, apologies the internet because I think it's raining, would be REITs, mainly because we think interest rates will continue to drop at least for the next 12 months. So I think there'll be a rush to capture some yield in the market. So as REITs and as we highlighted before, REITs get this unique benefit of when the share price is up, it actually helps the underlying business because it can actually make inorganic growth like what was mentioned. And then when you have lower rates, you have this virtuous cycle of becoming more attractive than bonds, because secondly, your DPU can grow because interest rate is down. And the third benefit is your assets can revalue upwards. So if interest rates are coming down the next 12 months, I think REITs would be a good spot. Yeah. The second one would be, for me, would be semicon, I think. Although we are a bit cautious on Franken in the very near term, but we are still positive on the whole AI spending. The weakness in the near term is partly because of what's happening in China. So I think probably a bit of over inventory, a bit of overbuilding, but we still think the demand for AI infrastructure. The unknown is whether the demand for AI will go to the edge, that means go into handphones. We haven't seen that yet. But if that goes, then I think there could be another run up in semiconductor stocks. So we think the capex spending, although there's a lot of worry right now and a lot of speculation, a bit of bubble, but I think the bubble more on the joint venture, on the VC side. But we think all this Google, they still have enough free cash flows to do all this spending, and they are all spending because they all want to get the monopoly on AI. If they don't spend, they will lose out. So it's almost like for survival reasons, no, they have to spend on AI. And we haven't seen AI being spent much yet by corporates and also by governments. Because generative AI is, it's only like a 2-year phenomenon or 2.5-year phenomenon. GokuLand and PropNex buy or sell. Yeah, we got a few questions on PropNex. So we still, I mean, PropNex valuations even after the run up is probably 13, 14 times forward. So it's not like very, very expensive. But it's just that for us, we are a bit cautious on the regulatory environment because if we get another the worrying thing is that if the property market gets a bit too hot, I mean, lack of a better word, if we get another very strong launch, we're just a bit wary what the authorities might do. So that keeps us a bit on the sidelines, especially when the stock already rallied almost 100 or even 200%. So that's why we are a bit more cautious on PropNex. The results will definitely be stronger, but it's more if there's if there's any, I wouldn't say cooling measures, I think maybe they might taper down on the leverage requirements. CDL or GokuLand, I think I leave it to Darren. Why the US market strong despite government shutdown and data blackout? I think because of the first experience in 2018, if you had sold out, then you would have lost out because of this blackout. Because the impact on the economy is hardly anything. Even after 1 month, the real impact is 0.1% of GDP. I think we touched on it last week. Because even though the government workers may leave, they actually may not get paid, but they are furloughed. They said they will actually get back their back pay. So actually the economy recover. Of course, this time round, Trump wants to cut the jobs permanently, but even that also, the impact on the economy so far, the market is not pricing it in because these things can get resolved overnight. So let's say you sell everything, then tomorrow they say, okay, we have room to recover, then you're going to buy back again. So I think that's why the market isn't pricing this because they've seen this shutdown has happened almost every other year. Yeah. Of course, this time may be more severe than last time, but the last time was only 0.1% GDP. Which of these small caps management is willing to do more given the EQDP? Okay, so I think the next 50 liquidity index is going to be quite important. I think if you are looking for ideas, that will be the bench, that will be the universe to use. Because this index is so important that the most important people who did all this program also did mention that there is a need for a small mid cap index. So for them to even say there's a need, so this is going to be a very important index, which I think a lot of the EQDP funds will be benchmarked to. My guess is the first round of EQDP, the 1.1 billion, it was hard to push them to buy small mid cap because there wasn't really a benchmark to use. So maybe with this benchmark, a lot of the remaining 4 billion can be benchmarked against this. So you can't, as a fund manager, say, no, I don't have a benchmark. You cannot measure me, but you cannot avoid it now with the next 50 indexes. So I think this is going to be quite an important index of universe of stocks for small mid cap. Yeah, of course, for us, we don't use that. We just go bottoms up. But if you're not familiar, then those are some of the stocks there. So let me answer one more before I hand to Zane. Hi, Paul. What's your view on the HRNet? What's your view on your HRNet share placement? I think it's positive. Again, going back to the index, even though HRNet is 700 million market cap, it's not even on the index because the liquidity is poor. Yeah. Okay. Thanks. Can I hand over to you, Zain? I will type in some of the questions. Yeah. Thanks. Apologize for coughing. Yeah. Thanks.
Okay, thanks, Paul. I'll start on the TA with by sharing my screen. Just give me a moment. Okay, so first question is on Q&M. I think Q&M some slight weakness for now, but I think overall we could just maybe see some sideways because recent weakness is because price there was a breakdown of this 47.5 cents level and then price is continue to just face resistance around the 10 MA level, and then the 5 and 10 MA levels was still below the 20 MA level. So it's something similar to previous pullback over here, July to August this year. So unless you need to see price try to break back upwards, then we can see a continuation of momentum upwards. But for now, some slight pullback, some support is holding around 45 cents, previous swing high resistance. So I think maybe we could see maybe some sideways consolidation between generally 45 cents to 47.5 cents area for now. Yeah, then it's around the weekly is around a 10 MA level as well. So there might be some support around 45 cents for the time being. Next one on Hobby Land. Yeah, for Hobby Land, I think generally it's I think it could be in an uptrend, generally in an uptrend channel over here. Yeah. And then price, I think currently might be doing a bit of a pullback, and from the resistance close to about 229, and I think most probably we see some sideways around 215 to about 224 for the time being. Yeah, and we've given that 218 previously was a swing high resistance, and then price is holding some support around there. So yeah, current price actually was some sideways consolidation going on. Yeah, maybe we see possibly wait for the for retest for the 10 MA on the weekly as well. Something over here that's held as support previously in mid-August. Next question is on Alibaba. And so for Alibaba, I think the trend is still very strong. Generally, since starting of September, price has been holding very well along these 5 and 10 MA levels. So I think possibly a bit of a slight pullback for now, given that around 187, 188, there could be some resistance based on previous resistance levels. So maybe some slight pullback, but I think if it does pull back towards like 173, 174 over here, we likely to see some support. Because there will be like the 10-day moving average as well as this horizontal level that it broke out last week. Yeah, so some slight pullback, but I think overall the trend is still very strong. And after 188, I think, let me try to find the next key resistance. Yeah, previously 188 was like a support breakdown level back at 2021. So after that, after 188, I think the next key level to look maybe somewhere close to 200. There will be a psychological level as well. So still a strong trend, but just some slight pullback. Given that the index is also pulling back today as well for Hang Seng Tech. Next question is on Berkshire Hathaway. Yeah, so for Berkshire, I think looks like a sideways consolidation for timing. So since price broke out of this downward resistance line in mid-August around 475, price went to retest back this previous horizontal breakdown level close to 500 around here, and then we just seen price moving sideways. So I think most likely just still some range bound price action between 487 to about 500, 505 generally. Next one is on WeHe. I think WeHe in the short term we might see some pullback, because on the weekly chart it has retested there's been some pullback recently that retested the 10 MA on the weekly around 71 cents, and then some rebound last week back towards the 5 MA around 74 cents about there. But currently, I think there's 3 weeks in a row, there's still some resistance around 74 to 75 cents area. So unless price can break above that, for now we might still see some slight weakness. Yeah. And I think it's quite important for around 72.5 cents to hold, which is the weekly 10 MA level. And going on to the daily, it's at this short-term channel support as well. So this this 71.5 cents, 72 cents area, it's important to hold for the price to actually rebound upwards. If not, we might continue to see some short-term weakness since the short-term, the 5-day, 10-day moving averages are currently below 20 MA as well daily. So it looks like some sideways consolidation and some short-term weakness. Next one is SSP Global. Yeah, so for SSP Global, I think generally it's just sideways consolidation for quite a period of time. I think that might still continue unless it can break above like the 70 cents mark. Yeah, but for now, overall, the rebound since April has been still intact. I think it's just moving sideways. The good thing is that price is still holding above 67 cents, previous swing high resistance as support, and still holding this upward support line. So unless that is being breached, still the upwards trend is still intact and just moving. I think we might still see some continued sideways, generally between 67 cents to 70 cents for the time being. Yeah, then if you can break above 70 cents, then the next key level will be around somewhere around 74 cents to 75 cents, previous support levels. Okay, next question, HST, which is the Line OCBC Hang Seng Tech ETF. Yeah, so for the Hang Seng Tech ETF, it's very strong since it has managed to, the recent upwards move has actually broke above this $1.03 swing high resistance formed previously in March this year. And then this was after a period of sideways consolidation and breakout. So today there's some slight pullback for this, but I think if it goes to retest back this $1.03 to $1.04 area, which is currently the 10 MA level, I think we should be able to still find support over there. Yeah, generally it's still a very healthy uptrend overall. Yeah, just that tends to do a bit of consolidation and then we are ready and consolidation again. So afterwards, next key resistance upwards, I think will be around $1.13 to $1.17. That was previous resistance area in August to November 2021. Yeah, so that will be the next area of resistance to look at. And next one is on Valuetronics. Yeah, so for Valuetronics, I think some pullback recently from the channel resistance area as well as a horizontal resistance at 90 cents. Then I will expect around this 82 cents to be a hold as channel support. Yeah, so it looks like just some consolidation over here for now. Price seems to break above this resistance around 85.5 cents, which is also the daily 220 MA level. Then we might see a recovery outwards. And so for now, looks like some sideways consolidation between like 82 cents to about 85 cents area. The next question is on Franken. Yeah, so for Franken on the daily chart, it looks like I think just still some sideways consolidation overall. Yeah, generally between like around 139 to 151. So today a bit of a pullback after Friday we tested this swing high resistance. So what preferably if price want to go up, I think what we want to see is for it to hold the short-term moving averages around here like 144, 145, as well as this, which is also this area of resistance previously back in end of August to September. So you can form a higher swing low, then afterwards there might be a chance of a breakout. But for now, overall, it's still rather sideways. Yeah, so I think most probably some consolidation again. Yeah, since overall it's in the range, and then weekly chart, yeah, 145 146. If this can hold as a higher low, then that will be better. Next one is on Lam Chang. Okay, Lam Chang volume is quite low, but overall chart is in an uptrend. Then recent pullback to retest this previous range consolidation resistance still held at support 42 cents. And then some slight rebound recently. So yeah, currently price is above the short term, the 5, 10, 20 MA short term moving averages. So that's still positive from the recent retest of prior resistance. And hopefully if price can hold like 44 cents, I will consider this 42 cents to 44 cents a range over here. If price can break out hold this as support, then I think it'll be quite positive for price to rebound back to try and retest some of the recent levels from end August, September. So that'll be the next resistance might be somewhere around 47 cents. And then the swing high around 50 cents about there. The next question on SIA. So for SIA, I think yeah, price is last week it trying to break out of this key level around $6.55. So this is a support breakdown level held as resistance, but last week trying to break above and the 5-day MA especially above the 10 and 20. So if price can hold like let's say like this 653, if this area can hold as support and then subsequently try to break upwards again of 657, then there might be some recovery in terms of share price. Yeah, but I will expect the next quite a lot of reasons upwards again, like 663 is also quite a strong reason in the past. And generally it's still in the range. Like just sideways between 648 to 664 about there since August. The next one is on Yangtze Shipbuilding. I think it's still very strong. So last week there was last Monday there was a sharp pullback over here, and then intraday we saw recovery after it tested some of these previous horizontal level around 315. Then also went back up to test this 338 level that has been holding as a bit of resistance. So good thing is that there's still multiple tests of resistance, which shows that buyers are still quite strong, and then price is still forming a bit of a higher lows generally along the since last Monday. So I think there could be a bit of a consolidation over here, but generally if can hold around 330, which is like the lows of the past 2 days, then there might be another run up if it breaks out of this 338 again. Yeah, since generally it's still on the uptrend, and then there was quite a strong recovery from this sharp pullback last Monday, which shows that buyers are still strong in this counter. Okay, next one is on Sembcorp industry. So yeah, good development for Sembcorp is that finally after this very long sideways since mid-August, we've finally seen the breakout of this 618. Yeah, so fully price can hold and price can hold the short-term averages as supports. And then afterwards there could be some recovery. Yeah, on the weekly chart, hopefully can hold like 612, which is the 5 ME level that previously was acting as resistance, and there was a breakthrough last week. If so, if you can hold a support and subsequently we might see some recovery in terms of the share price. Then I would think the next key is resistance was maybe up 650 to 665 area. Next question on sets. Yeah, for sets, I think it's still trending well. So overall uptrend since April rebound still intact, and recently broke out this ascending triangle consolidation 335, 336, and recently testing this 353 previous resistance level. We might see some sideways over here, but I think still very strong with the probably we see this 5 MA as well as 10 MA holding as support. So that's currently around 347 and 343 currently. You might see some sideways consolidation over here. Then I think we might afterward then we might see another breakout again to test maybe 366, the next resistance level. Yeah, so I think it's about one. I think there's still quite a lot of questions for the TA. I think sorry, I'm unable to take all of them if you have time, but feel free to post all your questions in our OEM3 community chat. Then I will answer it over there. Yeah, I think I'll hand over time over to Paul if you have any more comments or questions to take. Thanks.
Yeah, thanks, Zane. We got just one last question. I think how is this new index different from the small mid-cap index? I think this index is look to be unofficially more endorsed than and no coincidence that this index was launched in the middle of this whole EQDP program. So I think that for me is probably the larger the more relevant event, yeah, and it seems to be more investable, yeah. But although the small mid cap index, I was just double checking, they do have some large cap names, but I think it's more kind of unofficially endorsed by SGX and kind of inverted comma everyone. Yeah, that's my own interpretation, yeah. Okay, with that, I think we tried to stop by 1 p.m. So thanks everyone for your time. And I know there's still more, like 90 questions. So I think, yeah, so sorry we can't answer everything because it might be taking too long. But feel free to go to our community chat and then we will try to answer. There's some of them there. With that, I'd like to thank everyone for your time. Hope it was helpful for you. And we wish everyone to have a wonderful week ahead and take care. Thank you, everybody. Bye-bye.